Hello and welcome to Stockwatch Live. Now, in recent years, there have been a variety of efforts in countries around the world to slow public sugar consumption in an attempt to ward off obesity and obesity-related diseases. These efforts have taken the form of direct taxes on soft drinks, public awareness campaigns, and even threats by various governments to get the food and drink industry to lower the amounts of added sugar in products. The jury's still out on exactly how much of a positive impact this sugar tax has had, but one thing that surely can't be entirely unrelated is the worldwide sugar surplus. This has left the largest producers around the world with huge stockpiles. Unusually heavy rains across Asia, as well as an uptick in European production following the EU's deregulation of domestic sugar production, have certainly played a part. But when you think that companies like Coca-Cola, which uses 14% of the world's sugar, now has 200 new low-sugar formulations in the works, you can see how consumer demand for less sugar also plays its part. So it was a very slick move by Tate & Lyle indeed to sell its sugar business. The company, which was formed in 1921 from a merger of two rival sugar refiners, Henry Tate & Sons and Abram Lyle & Sons, ended its long association with refined sugar production in 2010. It sold its entire sugar business, including its famous Lyle's Golden Syrup brand, for £211 million in cash to American Sugar Refining. It's since repositioned its business to one which produces low and no-calorie sweeteners and specialty fibres as part of its health and wellness offering. Back at the last year end, it said it was this shift in its core products that made it increasingly well-positioned to cater for the growing consumer demand for healthier diets with less sugar, fewer calories and less fat, and more fibre. Due to post-half-year results on Thursday, at the last count it was lower corn costs that were causing a dip in Tate & Lyle's sales. Brokers' views are mixed. Jefferies International rates the share as a hold, but has raised its price target from 700 to 725 pence, while Kepler Chevreux has downgraded its investment rating from buy to reduce and cut its price target by 10 pence to 620 pence. More positive are Soc Gen and Liberum Capital, who both rate the shares a buy and have set price targets of 750 pence and 900 pence respectively. Now, if you like your results sugar-coated and you're a shareholder in Associated British Foods, you might be in luck. While the sugar surplus certainly isn't doing ABF any favours at all, its ownership of value retailer and fast fashion brand Primark more than likely still is. And that's doubly lucky when you consider the less than sweet fate of so many retailers in the current climate. But Primark is proving to be one of the shining stars on an otherwise less than glittering high street retail scene. Primark has so far performed well in the UK, with full-year sales expected to be 6% ahead of last year, as the retailer significantly increased market share in the 12 months under review. Like-for-like growth for the full year is expected to come in around 1.5%, driven by a strong first half and a second half performance in line with an exceptionally strong second half last year. Now, on their own, these percentage changes may not sound overly spectacular, but for a retailer to be making any headway at all in a climate in which consumers are increasingly reining in their spending is indeed a rare thing. Such is Primark's positive contribution that it's expected to be more than enough to offset the weakness in the sugar division. Their revenue and adjusted operating profits are expected to come in lower than last year. Grocery revenues, meanwhile, are expected to be ahead of last year and adjusted operating profits well ahead, driven by growth in sales of its chocolatey malt drink Ovaltine, improved margins at George Weston Foods in Australia, and the first year of contribution from Acetum, a balsamic vinegar producer. RBC Capital Markets has reiterated its outperform rating but cut its price target from £31 to £27. Barclays Capital is overweight but has cut its price target from £33.40 to £32.80. Credit Suisse has repeated its outperform rating but cut its price target from £33 to £29.50. The only bear is Goldman Sachs, which is neutral on the stock and has a price target of just £25 on the shares. Sticking with the food and retail theme, supermarket chain Morrisons is due to give a trading update on Tuesday. At the half-year stage, it reported a 9% increase in its first half profits and its best quarterly like-for-like sales in almost a decade after extending its scope into wholesale. That's solid progress for the third largest listed UK supermarket group, which began cutting prices and closing less profitable stores several years ago to battle the growth of discount food chains Aldi and Lidl. and it's still only partway through its turnaround strategy. Morrison is clearly open to new opportunities and already delivers via Ocado and supplies corner shops and Amazon, but Amazon ultimately remains the enemy of the sector, not an ally. Pressure is continuing to mount, as we've seen, with Sainsbury's buying up Argos and now Asda in an attempt to beef up its operations. And that's not forgetting the double-pronged threat from German discounters Aldi and Lidl, which Morrison is well aware of. Investors will be interested to hear what it has to say about its failure to overturn a court ruling that it should compensate thousands of workers after a disgruntled colleague posted payroll information about them online. The Court of Appeal rejected the company's challenge to the case brought by just over 5,500 staff on the basis that Morrison's was vicariously liable for the leak. The concern is that with more than 100,000 employees affected by the data leak, a class action like this, the UK's first, could be potentially ruinous. However, in Morrison's case, lawyers have suggested that while the supermarket group's planned appeal at the Supreme Court is likely to fail, because it's not clear that any employee has suffered material loss, compensation could be minimal. Broker Credit Suisse has upgraded its investment rating on William Morrison supermarkets to outperform from neutral and raised its price target from 255 to 285 pence. Berenberg has moved from sell to hold and lifted its price target from 210 to 250 pence. Finally, Marks & Spencer's half-year results, due on Wednesday, will be keenly watched. At the full-year stage, M&S booked a 62% fall in profits because of costs associated with store closures and a squeeze on margins in its food business. However, it kept its full-year dividend flat at 18.7p a share and said the first phase of its transformation plan, to restore the basics, was well underway. Investors will be keen to hear more about the new organisational structure, which Chief Executive Steve Rowe said would largely be in place by July. For Mr. Rowe and his team, their job is to make it a faster, lower cost, more commercial, more digital business. If all goes to plan, the new M&S should be back into sustainable, profitable growth within 3 to 5 years. With 100 stores set to go by 2022, during the 2019 financial year, M&S said it expects to reduce space in its clothing and home business by around 5%. Gross margins should increase by 50 basis points, though the first half is expected to be adversely affected by currency and the timing of sales. In the food business, which has, as I already mentioned, been squeezed on margins, the company said it expects business to remain broadly flat. Brokers are very wary of the stock. Liberium Capital rates the shares a sell and has set a price target of 250 pence, and HSBC has downgraded from buy to hold and cut its price target by £1 to 300 pence. So, Credit Suisse looks positively upbeat compared to the others, remaining neutral but lifting its price target from 285 to 315 pence. Well, that's all for this week. To find out more about the companies reporting in the week ahead, go to the Markets and Insights section on fidelity.co.uk. Thanks for watching.